What's going on, guys? Alex here. Today, I'm answering your tax questions from Reddit. So today's question has to do with long-term capital gains and how the rates are calculated for income tax purposes. Beautiful question. I love this question. It's submitted by Efros Financial, and it says the following. I plan to realize approximately $100,000 of long-term capital gains in tax year 2020 from the sale of vacant land. I've never reported long-term capital gains before, and I want to see if my understanding of how the tax rate is determined is correct. My ordinary income from my job will be $80,000. I'm married and will be filing jointly. I understand the 0% long-term capital gains bracket ends at $80,000. My question is this. Do I add the long-term capital gains to my ordinary income when determining which long-term capital gain tax bracket I fall into? For example, I would use $100,000 as my income when determining which long-term capital gains bracket I fall into. If so, would all of my long-term capital gains be taxed at the higher rate, 15%? The online tax calculators I use to estimate this are unclear on this point. Some examples to see if I have this correct. So in the first situation, married filing jointly, $50,000 ordinary income, $20,000 long-term capital gain. All long-term capital gain is taxed at 0. Second situation is $50,000 ordinary income. The $100,000 long-term capital gain, $30,000 of it is taxed at 0 and $70,000 is taxed at 15. And for married filing jointly, 0 ordinary income. So these are a bunch of different examples. We're going to stick to the base example, right? Because we don't want to get too crazy. So let's pull up, first of all, where all this comes from. So if you just are a layperson and you Google capital gains rates 2019 income tax, what have you, you're going to be confronted with these websites that give you the long-term capital gains rates. And this is where some would say, misinformation comes from. So let's look at married filing jointly because our friend Efros Financial is filing jointly. So this is where that $80,000 amount comes from, right? You'll see a lot of people referencing this $80,000 amount. The 0% long-term capital gains bracket ends at $80,000. So when people say that, they're referring to the fact that this long-term capital gains rate is 0, and then it's based on your income, taxable income technically, and it's 0 to $78,750. So people round that off to $80,000. That's what they're talking about. And this is the common layout that's seen by taxpayers, and they're kind of confused as to how this all plays out once you put all the numbers together. Do you include the capital gains in this income amount? Do you not? And is part of those capital gains taxed at one rate, part of those capital gains taxed at another? Let's find out. But first, we're going to take a swig of tea because when doing tax work, you just have to. All right. Beautiful. Now we can rock and roll. So let's pull up the good old-fashioned tax software, and let's project this situation. Why not? All right, so let's put together a 1040 here with married filing jointly. We have test client. Let's put spouse client in there as well. We're going to build this up. All righty. So it didn't specify which state you live in, so we're going to pretty much focus on the federal side of things. All right, so it's going to give us an error message. Let's change this to that. Okay. All right, so we have a return here, 1040, 2019. We got married filing jointly, and we have $100,000 in capital gains, which we'll address later. But what else do we need to take into account? So my ordinary income from my job will be $80,000. This individual didn't specify any income from their spouse, so we're going to assume that the wages are just going to be $80,000. All right? So taking a look at the return, we see that the wages is $80,000. We have $100,000 in capital gains. So let's just double check that that's where we are. All right, so we have here long-term, 100,000. Okay, that was in there from another example I did for a different question, but it's applicable, so we're going to keep it. So I plan to realize $100,000 of long-term capital gains in tax year 2020. So what I want to do is do a before and after comparison of the tax liability before this sale and after this sale, just to see what effect it has on the overall tax liability for the year. So let's do that. And for that, we're going to pull up, a handy dandy spreadsheet, right? Come on. Those who have been watching my videos know that this is coming. All right. So we have the total tax, no long-term capital gain. All right. So total federal tax, no long-term capital gain. And let's find out what the capital gain amount would be. And we will compare. All right. So that should give us a good point of comparison there. Okay. Make it nice, presentable. All right. You guys could see it. All right. So total federal tax, no long-term capital gain. All right. Let me pull up the software here. So let's delete this for now. Okay. So we have no gains. Let's take a look at what the federal tax looks like. Now we have the standard deduction for married individuals, married filing jointly, $24,400. Again, sniffles get a hold of me sometimes. So excuse me. So the taxable income given the $80,000 in wages drops to $55,600. But what's the total tax liability? And that number is, and let's get rid of the tax penalties because they're going to shift our numbers. So we are going to suppress the penalties for now. All right. So the amount you owe in this case, or the total tax we're going to focus on, is $62.87. Okay. So that would be the amount if these long-term capital gains were not applicable. Now, again, this doesn't take into account any withholdings or anything like that. We're just looking at the total tax. So this is before even the income tax withheld from Forms W-2 is considered. So this is just the overall total tax liability for the year. Okay, so let's then input the $100,000 long-term capital gain. We do that simply like that. Basically, if you put 100,000 sales price, zero cost basis, you get long-term capital gain of 100,000 because we have these dates here. And let's see, for vacant land, long-term capital gains rates would generally be applicable because it's not depreciable. Now, if there was a building involved in this, then you'd have to deal with a whole nother set of implications known as Section 1250 on recaptured gain. You might have some recapture if the building's old enough, and there's a whole extra level of complexity that's involved if you're dealing with depreciable assets that you're selling. If this was vacant land, then it should not have been depreciated. So if there was no depreciation, there's nothing to recapture. There's no unrecaptured gain. So we can stick to this example. Just know that if there was building involved or any other sort of depreciable assets, this scenario would change significantly. All right, so now we have our 100,000. Let's just make sure that's all good. All right, so our tax liability then increases to $17,815. Let's just look back at the 1040. We have the same $80,000 in wages. We're married filing jointly. And we have the $24,400 as a standard deduction. The total tax comes out to $17,815. Okay, now what's the difference? Meaning, what impact did that transaction have on our tax liability? And we can see that difference is $11,528. So if you think of it in terms of the $100,000 in capital gains, let's just take a look at the percentage here. So this divided by the 100,000. Okay. You can argue that the effective federal tax rate of that transaction was 11.53%. Now, you have to take a look at the details of this by looking at a worksheet. So there is the qualified dividends and capital gain worksheet. And this is where this tax amount is calculated. So as you can see, going through here, we see that there, and it's a pretty complex worksheet. It's in the instructions for, I believe, Schedule D, that where you'd find this. But you'd see that there's a line that says, this is the amount taxed at 0%. and you see that it's $23,150. All right. And it does reference that $78,750 amount. It does a little bit of math here, and you can see that there is a portion that's taxed at 0%. Furthermore, there's a portion that's taxed at 15% as well. So essentially, you are putting together those tax amounts, and your effective tax rate on this transaction is 11.53% if you're just considering the effect of that disposition. So really what you have there is a blended rate whereby a portion of the gains are taxed at the 15% rate and a portion are taxed at 0%. And what you're getting there is essentially a tax impact, if you will, of 11.53 or right about 12% overall. So that should hopefully give you a better idea of what's happening under the hood if you have this transaction occurring in a particular tax year. And overall, that's going to be the approximate impact. Now, again, this isn't me doing a tax return for you. There's a lot of other things to take into account, so don't just put these numbers on a tax return and file it. But this should give you a general idea of how the mechanics work from an income tax perspective. Now, for many states, there may not be a preferential long-term capital gains rate. So those gains may be taxed as ordinary income. So California, I know for a fact, does not have a preferential long-term capital gains rate. And that being the case, you'll just pay ordinary income tax rates based on your marginal bracket. So hopefully this provided some insight for you, Fritz Kubiak, in terms of how this is going to play out. It's essentially going to be a blended rate of a little bit of 0, a little bit of 15. You throw them all together, and the net tax impact is going to be this 11.53% overall. So hopefully this was helpful. If you got value out of this, feel free to hit that like button, subscribe to the channel, hit that bell icon, drop a comment. I love reading the comments. And ultimately, hopefully this was helpful. Thanks for watching.